So I wanted to make a quick video about moving averages. You see a lot of lines on this chart. Some of you who are new to this system, you might find these lines confusing and you might not be aware of why we are using all these lines. There is a specific purpose to each line. Okay. So let us first understand what these lines are. And remember the color combination. Preferably keep the same chart layout or format that I am using. Have a black background. Don't have a white background. It is not good for your eyes. Have a black background and preferably use these colors so that when you watch my video, okay, same thing you can understand on your own chart. Okay. So first you see volume. This is the blue line, which is the 50-day simple moving average. The blue line here is the 50-day simple moving average of price. The green line is the 150-day simple moving average of price. The red line is the 200-day simple moving average. The purple line is the 21-day exponential moving average. It is not the simple moving average. Okay. Now don't ask me why is simple, why exponential. Okay, that's for academic reasons. I will tell you the practical application. So purple line is the 21-day exponential moving average. Orange line is the 8-day exponential moving average. So let me classify these moving averages to you. The green line and the red line are called as the long-term moving averages. The blue line is called as the intermediate term moving average or the medium term moving average. And the orange line and the purple line are called as the short term moving averages. Okay. Now, what is the purpose of these moving averages? So, number one, let us look at the moving average on volume. If the volume bar is above the blue line, we say it is a high volume day. When the volume bar is below the blue line, we say it's a low volume day. And when the volume bar is touching the yellow line, sorry, the blue line, then we say the day was close to average daily volume. Okay. That's how you interpret this uh, moving average line. So it helps you determine whether you are witnessing a high volume day or a low volume day. This is important for us because on the day of the breakout, we want a high volume breakout. Okay. So that's the purpose of this blue line. What's the purpose of the long term moving averages, the green and the red? Well, the green and the red are the long term moving averages. So they show us the broader trend of the stock. So remember, I had told you the stock goes from stage one, which is the dormant stage, to stage two, which is the uptrending or accumulation stage. From stage two, it will go to distribution stage, which is stage number three. And then from stage three, it will go to decline stage, okay, where the stock is falling, which is the stage four. So dormant stage, uptrending, accumulation, distribution, and complete outright decline. Okay. So these long term moving averages help us determine the transition from one stage to another stage. So, for example, when the stock is dormant, okay, the stock price is fluctuating around these two moving averages. Let's see if we can find that dormant stage here. See, this is the dormant stage from 2021 to around 2023. You can see the price fluctuating around these moving averages. So that's the dormant stage. But there comes a time when the price goes above the green line and the red line, and the green line itself goes above the red line, and both turn positive slope. Okay. So let me repeat that. There comes a time, see, you see this high volume spike. That's the signal that probably the stock is going into stage two. So there is a transition from stage one to stage two. So the price starts to trade above the uh, long term moving averages. The green line goes above the red line, and both are sloping up. Okay, so that's it represents a transition. Okay, so the long term moving averages help you determine when that transition is taking place in a stock. So the long term moving averages are used to determine the stage and the transition from one stage to another stage. Okay, so for example, in the decline stage, for example, if you see this stock in the decline stage, you will notice that The green line has fallen below the red line. In the stage 2 or uptrend, it's exactly the opposite. Here, both of them are sloping down. In the uptrending stock, both are sloping up and the green is above the red. So you see, you can easily classify stocks into different stages based on the long term moving averages. Now let's come to intermediate term. So now you understand the purpose of these two lines and the purpose of this line. What about the intermediate term, the 50-day simple moving average? Well, if you are a positional trader means you buy a stock which is trending up and you hold on to that stock as long as it remains above the 50-day simple moving average. That's the purpose of the 50-day simple moving average. As long as the price is above the 50-day simple moving average and the 50-day simple moving average is trending up, we say that the stock is in an intermediate term uptrend. Okay, intermediate could be, let's say, 6 months, 12 months to 18 months. So 6 months to 18 months. If you are a positional trader, you could hold on to a stock from 6 months to 18 months. The stock will remain above that blue line. There are many stocks you can go and check which have remained above the blue line for extended periods of time. Those are called as positional trades. So this line is extremely important if you like to hold on to a position as long as the stock is in a uptrend. Okay. So that's the purpose of the blue line. Blue line means positional trading. Then you have the short-term moving averages. This was discussed by Patrick Walker, who is a veteran trader who uses MarketSmith, and he has more than 4 decades of experience. I have watched multiple interviews given by Patrick Walker, and he, along with one of his friends, they have done a lot of research on these two moving averages, short-term moving averages. The purpose of these two moving averages is to manage the trade. Okay. See, once you buy a stock, you need to also learn how to sell a stock. So for managing the trade or selling the stock, these two moving averages come in very handy. Now, the problem with short-term moving averages is if the moving average is too short. So let's say instead of 8 exponential, you use the 5 exponential. Then you will get whipsawed in the trade. You will get premature exit signs. The stock will close below the 5-day exponential and you will exit. And the moment you exit, the stock will start to go up. So the 5-day exponential will kick you out of the stock prematurely. And let's say you have the 10-day exponential moving average or the 15-day exponential moving average. Well, those will give you a late signal. Okay. By that time, the stock would have collapsed 15-20% from the top. So the 5-day will kick you out of the stock prematurely, and the 15-day or the 10-day will give you a late signal. Okay. So what do? You find a middle ground. So multiple years of stock market history was studied, and it was found that the 8-day exponential moving average is the optimum moving average where you can hold on to a stock as a short-term swing trader to manage your position. So if you notice this stock, I had bought it here between the two yellow lines. It crashed down, but it never closed below the 8-day exponential. And see, it seems like the 8-day exponential is acting as a support for this stock. It seems like though. Okay. If I was using the 5-day exponential, probably I would have exited on this candle because it closes below the moving average. Basically, you use the close below the moving average as a sell signal. Okay. So in this case, that sell signal has not come. Also, it depends. Like if you buy a stock and if you want that to be a positional trade, then you have to ignore these two moving averages. Even if the stock closes below these moving averages, you should hold on to the stock. But as a short-term swing trader, you could use the 8-day exponential for partial selling, maybe cutting 50% of your position. So one way to sell is by selling into strength. Another way to sell is by selling on a close below the 8-day exponential. Another way to sell is to sell on a close below the purple line, which is the 21-day exponential. Now remember, as a swing trader, you should never hold on to a stock which has closed below the 21-day exponential moving average. So that's your main line. So as a swing trader, you could choose to be in a stock without selling a single share as long as it remains above the purple line. As a positional trader, you could choose to remain in a stock without selling a single share as long as it remains above the blue line. Okay. So, positional trader, the blue line is important. Swing trader, the purple line is important. Partial selling, orange line is important. Stage analysis, long term moving averages are important. Looking for high volume breakouts, the blue line here becomes important. So that is the purpose of each of these lines that we are using on the chart. So I hope this video was helpful. Thank you so much for your time. Thank you so much for your support. Please like, comment, and share this video so that this video will reach those people who genuinely want to become professional stock traders just like you. Okay. Thank you so much for your time again. I will see you tomorrow in the next video, and send me your questions. Your questions will give me an idea to make a video. Generally, I look at what questions are being frequently asked, and then I take that question and make a video on it. Okay, so please don't hesitate to send me a question either on the YouTube comment or email me or WhatsApp me. Okay, and WhatsApp is better because I can reply with quickly with a voice text. But I generally look at the frequently asked questions and I immediately clarify it on the YouTube channel through my video. These are extremely valuable videos. There is a lot of information I am sharing here which can help you in the long run. So if let's say your age maybe 35 and you plan to trade till 75, then you have 40 years ahead for trading. So out of 40 years, if you just invest 1 year of your time in learning, imagine how much that 1 year of learning can impact your the remaining 39 years of your trading. So please spend half an hour per day on my YouTube channel. You will notice an increase in your skill as a trader. You will improve your skill as a trader. Okay, you will become a better risk manager. Thank you so much for your time again.